Now, tax planning is one of the biggest opportunities that people who are retiring have to add value to their financial plan. Yes, we want to talk about income planning and retirement and Social Security and Medicare and investments, and we do all of that, but we don't stop there. We actually want to do a lot of tax planning to ensure that clients pay as little as taxes or little in taxes as they legally can over the course of their retirement. So in doing that, I want to give you an example of what that looks like. And what this is the names are redacted, of course, but what this is this is a tax report that we ran for a client. And what we did is she was making a great income. She was still working. She's a couple years away from retirement. And she knew that she was in a high tax bracket today. And her concern was this was never going to end, even in retirement. So here's what we did for her. We ran a tax report. We took her tax return for 2019. We took a look at what was your total income, your adjusted gross income, after deductions, what was the actual taxable income that you had? So she had taxable income of $340,000. Now, what you can see, the way taxes work, and this is just the federal side, this is before any state taxes, but the tax bracket is progressive. And so what you do is you pay taxes at marginal rates that progressively get higher. So the first amount of income that you have is taxed at 10%. The next amount of income that you have is taxed at 12%. Again, this is for 2019. And so on and so forth from 10 to 12, 22, 24, 32, 35%. So she had effectively filled up all these buckets, and any other dollars on top of what she was earning were at the 35% marginal tax bracket federally plus state. So what we looked at for her is we said, okay, here's exactly where you are today with ordinary income. And here's where you are with capital gains. So any capital gains that she would earn, she would pay 15% federally on those capital gains. And the next dollar that she earned, all the way up to $510,000, but between there and where she was, she would pay taxes at 35%. So anyways, we looked at that simply to say that today you're in a high tax bracket. Let's do everything that we possibly can to shift you into a lower tax bracket. For her, is a combination of 401k, HSA, a deferred compensation plan that she had through work, as well as a couple of other strategies that we looked at too, to say how can we keep your taxes as low as possible today, because we didn't stop here. What we also did was we ran a tax report for 2023. And what we did is we said 2023 is the projected retirement date for this particular client. And in 2023, her salary would go away. She would have her 401k and Roth IRAs and other investment accounts, but those aren't taxable unless she draws from them. We ran a projection that said, what would you be taxed at if you just had Social Security at this point? So before factoring anything else. Well, if she was just living on Social Security, what we found was that her total adjusted gross income would actually be zero. Because depending on what your income thresholds are, Social Security may be taxed or it may not be taxed, or anywhere in between. So there's kind of different thresholds at which Social Security gets taxed. And for her, what we saw was she went from the 35% tax bracket all the way down to the 10%, and in fact, she was at the very bottom of it. She really didn't have any taxes that would be owed in this initial scenario. So what we told her was we said, hey, this looks great. You're going to retire and taxes are going to drop a lot. But when you hit 72, and then these ages may be pushed up shortly here, but when you turn 72, you're going to be required to start taking a lot of money out of your 401k and IRAs. And so you're going to be working today and have a very high income and a very high tax bracket. Then you're going to retire, and income is going to be very low for a few years, and then required distributions are going to start and push you right back up into the 32 to 35% tax bracket. So what we told her was we said, let's take advantage of these years. These kind of what we call valley years between retirement and required minimum distributions when taxes are low. Instead of just paying nothing in taxes these years, let's strategically convert money from your IRAs and 401ks to Roth IRAs. And let's convert just enough to fill up the 10% or 12%, maybe even potentially a little bit of the 22% tax bracket, because what that's doing is it's saving you from having to pay taxes at the 32, 35, and who knows what they actually are by the time that this client turns 72. So what we started to do is lay out a strategy that said year by year, how much should you look to convert from your IRA to your Roth IRA? Or year by year, what are some other potential tax planning strategies that we can look at to ensure that you're keeping income as low as possible? Here's another one. Most people don't know this, but if you're under a certain income threshold, any capital gains that you realize, you don't pay any federal taxes on those if your taxable income is under a certain threshold. So we look at these strategies that say, should we do Roth conversions? Should we intentionally realize some capital gains that you have from your standard investment accounts? Are there giving funds or donor advised funds that we can set up to do some charitable giving and really consolidate all the deductions you could potentially get from that all into 1 year to save a significant amount of taxes? We look at everything from Roth IRA contribution limits, lifetime learning credits, making sure that you're taking advantage of everything that you have available to you. And then in retirement, the other thing that people often overlook is Medicare premiums. So Medicare Part B and Part D premiums, there's a standard amount that you're going to pay for that. But once your income starts going into different thresholds, there are additional premiums that you would pay. So what we want to avoid is we want to try to control income and try to make sure that income isn't crossing over any thresholds we don't want it to, because not only does that increase income taxes, but it could potentially increase the capital gains taxes that you pay, and it could potentially impact what are called the IRMAA surcharges, or the surcharges on your Medicare that you might pay depending on the level of income that you have. So on top of that, we have other observations. When we look at, we just want to make sure that we're looking at everything when it comes to taxes, so that by the time it's all said and done, when we're working with a client, you have a plan in place. You know where income's coming from. You know how you need to be invested. You know how you're going to elect Social Security or Medicare. And you know what you can do to strategically drive your tax bracket as low as it possibly can be, not just today, but over the course of the remaining years of your retirement as well.